Hey everyone, welcome to the Elite Real Estate Podcast. I'm your host, Sam Popple, along with my co-host, William McClellan. How you doing today, Will?
What's up, man? Good guess. Ready to make it happen today.
Yeah, no, today's going to be a great one. So we got our returning guest, Albert Sousa. If you want to get a little more of his background, check out episode 23, as he's a previous guest, great person in the community. But Albert is the visionary principal broker and owner of Mortgage Apex. He has a robust foundation in the mortgage industry. And then Albert's journey began in 2017, fueled by passion for learning and commitment to excellence. And so he has founded Mortgage Apex back in 2020. He's been going at it ever since. And today we're bringing him on to give us the state of the market. So without further ado, welcome, Albert.
All right, guys. I'm happy to be here. Thanks for having me, and thanks for having me back. It was a pleasure last time, so I'm excited to jump right into it.
And hey, if you want to go ahead and go live on your personal Facebook, it is ready to share if you want to share it with the guests.
Okay, cool. Let me hit this refresh page, and we'll get this going. All right, we are streaming it live, and I'll be sharing this here.
All right.
Yeah, man. Thanks so much again for hopping on. Super excited. Always a pleasure. If you guys don't know, Pints and Properties over Fort Walton Beach. Albert is the man making it happen. Make sure you guys check him out next Thursday. It's going to be a ton of fun. And Sam, I think you're presenting, right?
That's right.
Let's go.
So,
yeah, perfect little tee up right here if you're watching live. So make sure you catch them both. But yeah, man, let's kind of dive in. Let us know, right? Like starting from lending, that's always a big question that everyone has kind of getting into this game, no matter, even if it's just like buying your first home, which can be scary. So right now, state of the market, Feds just met. Let's start big picture. Where is the mortgage market going right now through, as mid 2025 to the end of the year?
Yeah, great question. We've had a lot of changes. No doubt. I think that people are getting used to this new normal, if you will. Rates being higher for longer. You've probably heard that in the news. And so rates, the Fed met today and they decided that they're going to continue to keep rates where they're at. They're not going to. And so where it is right now is that people have kind of gotten used to it, but there's definitely some downward pressure because I think what happened from like 2022 when rates first started climbing till today, and we're a little off of the highs, but from then until now, there has been, and you've probably heard this, there's been a huge amount of demand, right? So there was just all this excess demand, all these excess buyers. Even though rates were high, there was still transactions happening because there was so much demand. Well, now fast forward from 2022 all the way to where we are now today in 2025, and all of those people who could buy despite the high rates, I think those people have kind of shot their wad. And so we're at a point where affordability is getting tough. And that is where we're starting to see these meaningful price reductions, not necessarily over the whole country. There's some places that prices are actually still climbing. But especially here in Florida, especially in your vacation type markets, your mountains, your coastlines, your Airbnbs, they're not as sexy as they were before. And so, they're not performing as well. So you have people selling. But what I'm seeing is regionally, we're definitely seeing some downward price pressure, especially on homes that are, I would say in our area, over $350,000. There's like more higher priced homes. So that's what I'm seeing as far as like our regional area. And then when it comes to the mortgage market, we're seeing rates anywhere from about 6 3/4 for a conventional, about 6.5 if you're qualifying for some special programs with conventional, and then down to about 6 1/4 for VA and FHA. And that's assuming that you're not buying the rate down at all. So that's kind of where your base rates are. And it's come off the highs because at one point we were at 7 1/4, 7.5. And so now we're down to, 6 3/4. I mean, that's still a very meaningful drop, but it's been very slow. It's been a slow decrease. And I think we're going to continue to see that.
How are buyer behaviors shifting with these rates right now?
In a way, it's gotten easier for me because for a while people were just like, oh my gosh, these rates are so high. And now, we don't really get that as much. People know that rates are going to be higher. So I'd say in that aspect, people are kind of used to it. But on the other aspect, I'd say it has people hyper. I don't want to say scared, but they're hesitant, and they want to make sure they're making the right decision. Because when you're looking at a 2,000 square foot house for $350,000 and your payments like ridiculously cheap, like $1,300 a month, you're like, yeah, if the wall's a little messed up, like it's all good. My payments are cheap. When your payment's $2,500, $3,000, you're going to start nitpicking a little more. And so that's what we're seeing with buyers.
Definitely, because that's honestly, I was moving every single year for a while until I've been, like I said, I've actually stayed in this current house for 3 years now. And this is the longest I've stayed put in a long time. And it really has been because I kind of had to evaluate, my cost of living here with my low rate and my utilities, like everything I pay to live by myself is like $2,300 a month.
You can't find that anywhere else.
And it's like, it's so unbelievable. Like when I say it out loud, I'm just like, man, this is unbelievable. How did I ever land that? And I got a 3-bed, 2-bath house. Like, like it's not small. It's not huge. 1,500.
2-car garage. You got it.
Yeah. 1,500 square foot, 2-car garage. Like, so, yeah. I mean, it's a middle America home, and, but like I said, with it that low, it's like for me just to even get the exact same living circumstances, not go up, not go down, just move laterally, my costs like go up by minimally 50%, and I was like, and oftentimes double. So I know that's got me holding. So are you seeing a lot less refis right now?
We're seeing some. It's funny because if a lot of people just assume that refis are only available for people who are looking to lower their interest rate. That's not always the case. I've oftentimes taken people from a lower rate to a higher rate and still put them into a better position, mainly because mortgage interest is the cheapest interest you can pay. Even at 7%, it's still relatively cheap. And what I know is that with all the constraints in the economy, credit card balances are at a record high. I believe it's 1.2 trillion, and it keeps on climbing. I mean, it's the highest it's ever been by a long shot in history. Right. And so people are feeling that pressure. And so when somebody who's been in their home for many years, they've got a lot of equity, and maybe they've got, I think probably on average is, let's say, $15,000 to $20,000 in credit card debt. When you have that and you've got these minimum payments that are getting to that point where it's probably like $1,000, minimum payments doing nothing to the balance, then it starts looking pretty good to use that equity, maybe bolster their reserves so they don't have to go into credit card debt in the future. Also, and we've done several of these recently, also access some equity so they can do some home improvements because they are wanting to kind of stay in place. And then also pay off that debt. So even though that rate's going higher overall, they're still saving a significant amount of money every month. And now that payment is going more towards principal instead of those, minimum credit card payments that take literally forever to pay off.
Right.
That makes a lot of sense, because I was actually going to see what type of trends that are coming across your desk. Like, are people really interested in new construction with a whole bunch of incentives? Are most of the deals just like, completely lopsided from just 24 months ago, and now the buyers can pretty much demand what they want, like 10,000 towards closing. I need the fence fixed. I need the drywall patched. Give me another 5,000 in seller concessions, things like that. Buy downs. I know that's probably something that a lot of people are seeing, at least advertised to us by large home builders and things like that. Like, we can buy the rate down to X. What are some things that you're seeing most consistently? How can people leverage that if they're in the market to purchase a new home or a rental or something like that?
Yeah, we're seeing that. That's basically the baseline. Is we're seeing getting at least some seller concessions, but most of the time they're covering all of their closing costs by the seller. So there's some really good incentives there. Usually seeing something coming off of the purchase price, if depending on how it's priced. It's a buyer's market in my opinion. Like, it's straight up a buyer's market. They got all the power right now. There's more inventory out there. But I think what's really important is that people, if you are a buyer, you are truly working with somebody that's in this business, like on the real estate side. I'm not a real estate agent, but work with somebody who does this full time, because the market, it changes so fast. Like you could be working with your Aunt Sally, who maybe does a transaction every year or two, and she doesn't realize that, hey, this is like just normal. This is just the baseline. So she might be thinking, oh, you're asking for the world, but in actuality, like this is just normal. If we're really asking for the world, let's come way down here. So we're seeing, we're seeing good, I think good deals to be had from buyers right now.
How have recent Fed decisions and inflation data impacted the underwriting guidelines or borrower eligibility?
It really hasn't too much. The guidelines have stayed relatively the same for a long time. The biggest thing that affected us as far as like what the Fed has done and just like federal policy on mortgages was a couple of years back when they changed the way that that loan level pricing adjustments, basically they're called LLPAs, that those are assessed on investment properties in particular. So it used to be that investment property loans just through your personal name were a lot more competitive than they are today. And so now it's gotten to the point where investors are almost all it's gonna make more sense for them to go the non-QM route with like things like DSCR loans or just getting loans through their LLC than it did before.
Can we pump the brakes right there? Because a lot of listeners are investors. And I think what you're saying is really critical to some of the people that are listening right now. So if I'm a new investor or early on in my career, what's that trajectory that I need to be working with you on outside of going to Mortgage Apex and working with you directly? Like what are high level things that I should be aware of so that when I meet with you, I'm prepped, ready to go, and I can probably assess this deal slightly earlier before we connect?
Yeah, that's a great question. So when it comes to your rental, if you're looking at a rental property, you got to know what your strategy is. I have a lot of people that come to me and say, oh, I want to buy a rental property. They don't know if they want to do STR. They don't know if they want to do long-term. So know your strategy, know what you're going to be doing, and what you're looking for. When you have that buy box,
if it's my first and I don't know if I want to do long-term or DSCR, what do those mean for some listeners that are like really eager, they want to get in the business, but not exactly sure how?
Yeah. So then if that's the case, I mean, they need to listen to the Elite Real Estate podcast and listen to different folks. I mean, truly, they got to listen to listen to somebody who's doing midterm, listen to somebody who's doing STR, listen to somebody who's doing long-term, figure out what you want to do, listen to, some of the old Bigger Pockets episodes out there, go on YouTube, and there's a lot of resources, but I do think it's important to really nail down what your strategy needs to be, because it's going to be very different if you're looking at cash flow for a long-term rental versus if you're looking at an STR. I'll give you a quick example when it comes to mortgages. So we have a DSCR loan where DSCR, debt service coverage ratio, basically just needs to cash flow. So we need to make sure that rental income that's coming in is equal to or greater than the mortgage payment, which for a property that's set up for a long-term rental, that makes sense, right? You're probably not even going to want to buy a property that doesn't at least pay for the mortgage payment for long-term. And so that's something that you need to look for, because knowing that that's what you're looking for, that's going to basically set you up to where you're going to do that underwriting ahead of time and go, okay, hey, the rent is this much. I think the payment's going to be this much. And so you can do that. On the flip side, if you're looking for a short-term rental, then that's a whole different type of loan sometimes, because we have programs where we don't care about that ratio. You got to put a little bit more money down. But when you look at $1 million beach home, or any of those homes that are going to generally be geared towards short-term rental only, some of these beach condos, a lot of times they're not going to cash flow. And so you need to know as the investor, hey, this is probably not going to cash flow. And two, if it's not going to cash flow, I need to be working with somebody ahead of time knowing that it's not going to cash flow, so we can find that specific type of program that's going to be okay with it not cash flowing, because you're putting enough money down, and we're looking at this as more of like an appreciation play.
Got it.
Now, someone who's buying something like that doesn't have to cash flow, just so our listeners are listening, they would have to be able to make up that cash flow within their personal income or something then, right?
Not necessarily. We have loans that are specifically made that don't cash flow, but you're going to have to show like you have more reserves, or you're going to put a little bit more money down. But the whole thing is that, you're buying a property on the beach. It's worth $1 million today. Yeah, it might not cash flow or barely break even, but they're okay with that because they know that fast forward 10 years, that's going to be worth $2 million. So that's really what their play is versus it actually making money.
Cool. Yeah, and I definitely knew that appreciation would be there. I was just curious that if the bank would underwrite, if they would underwrite for appreciation,
There's
knowing
some lenders that will do it, yes.
things like, oh, wait, it happened, so that's why I was kind of curious. I thought that was very cool.
Just working on that appreciation play, collateral, and if you have anything, like we said, check out Mortgage Apex, go to Pints of Properties, and Albert's going to crush it. He's going to help you make that best decision.
Yeah, I had one more thing on that question about the recent Fed decisions and inflation data. I think that's the second part of the question I want to touch on.
Yeah.
That's really key because inflation data is the most important thing that the Fed is watching, and it is also the most important thing when it comes to mortgage rates. So inflation is the arch enemy of mortgage rates. I'm going to kind of run through like a picture of why inflation is so important. So when you are a hedge fund manager, you're a pension manager, these people who invest in mortgage-backed securities, which are basically, it's basically like a bond. So you buy these mortgages, they're all, there's tons of mortgages that are all bundled up, and then you say, hey, I'm cool getting 5 or 6% per year. So these big inflation managers, or these big hedge fund managers, they are trying to buy these mortgage-backed securities as a hedge against inflation. They're not really trying to make that much money. They're just trying to park their money somewhere and be on pace with inflation. So when mortgage rates are at 2%, and you as a hedge fund manager buy this bundle of mortgages and it's paying out 2%, but then inflation is at 7, 8, 9%, you literally made less money than if you would have just held on to your money and done nothing. So I love using the analogy of Twinkies because Twinkies never go bad, right? So if I have 100 Twinkies, and if I have $100 and Twinkies are $1 each, I could buy 100 Twinkies today. And in a year, I'd still have 100 Twinkies. But if I instead say, hey, I'm going to invest in these mortgage-backed securities, and I'm going to buy $100 of mortgage-backed securities, and in a year, I'm going to get $102 or $103 because mortgage rates are 2 or 3%. But if inflation goes crazy and all of a sudden Twinkies cost $2, well, I would have been better off just buying those Twinkies for $1 each instead of waiting a year, making some money, and now I can only buy like 54 Twinkies. That makes sense. So inflation is huge when it comes to all of these Fed decisions, and that's why the Fed is so focused on inflation, because they know if inflation gets out of control, and especially if inflation gets out of control long term, then all the investors out there are going to go, hey, maybe we're just not going to invest any of our money, and we're just going to hang on to that cash. And when there's nobody buying investments, that's when investments tank.
Scoop it up. No, that's a great analogy, by the way. I hope you guys like that. That's pretty awesome.
I'm gonna buy Twinkies without worrying about expiration now that I know they don't expire.
Hey, forget about gold. I'm just gonna buy Twinkies.
Yeah, dude.
Put them in the garage.
Put in my plan in case the world goes to crap. I got a stash of Twinkies just in case.
Yeah.
So are you seeing anything particular loan types, or is pretty much everything that's coming through dependent on what the deal structure is and who the buyer is?
It does depend on who the buyer is. I would say we're seeing more of the DSCR loans than we were before, just because of what I was saying before. And then we're starting to see some ARMs come back. I think that rates have been stable for long enough where ARMs might start to make a comeback. Like I just did one ARM, but that's the first one I've done all year.
What was the ARM at, if you don't mind me asking?
It was only about 1/8% lower than the fixed rate, but in that particular case, it made sense because they're not planning on being there that long anyways. And I think there's a high likelihood of us being able to refi in the future anyways too.
Right.
So, in that case, they were okay with it.
So talking again for maybe some of those early listeners, what is an ARM? Why would I want to take something that could fluctuate as you're doing that? And why is that maybe a better or maybe a creative financing tool or loan product that I would want to use? Because you're using this example of I'm not there very long. So what is once you explain it, everyone will kind of understand why that makes more sense. But if I'm new, just for some listeners that are maybe catching live or something.
Yeah, so an adjustable rate mortgage is what ARM stands for. Almost all ARMs now will have a fixed period, and then it'll be followed by an adjustable rate period. So most of the time it's going to be anywhere between 5, 7, or 10 years. The one that I did recently was 7 year. And so, in other words, you're going to have a fixed rate for 7 years. After that 7-year period, your rates are going to adjust usually every 6 months to 12 months. And so ideally, if you want to play it right, if let's say you're going to live in this house for 5 years, maybe you could do a 10 or 7-year ARM, because the rates are going to be a little bit better on that ARM for that fixed period than it would be for just a 30-year fixed. And so put yourself in the shoes of the investor. They're saying, hey, we don't know where rates are going to go in the future, but we're going to basically tease you with a little bit of a better interest rate for these 7 years, so that in the off chance that you do hang on to that mortgage and rates climb, then we're going to automatically get paid more in interest. So that's kind of how an oversimplification of how it works. But the key is, use it to your advantage. Really, if you think you're going to be in this home or even in this mortgage for more than the 7 years, then I probably wouldn't recommend it. And I'd instead go with the 30-year.
And I want to add in a caveat, is I love ARMs. So I've used ARMs like through. I would say out of all
this
the
guy's just a backs and buy kind of guy. He's only working out ARM.
Yeah, exactly. It's all about the ARMs. But no, I say probably about a third of all the loans I've gotten have been ARMs, and it's because so many of the things I do, whether it's in real estate specifically or even with my business where I got some real estate tied to it, I know I'm refinancing every 5 years. And so because I have that mentality, I know that it's like, well, since I know I'm going to do it anyway, I might as well only commit to it for 5 years. And I will say there's a little bit of caveats to this now that I've been through a low and a high, headed back to a low. I think now, and I want Albert to correct me if I'm wrong, since he is the mortgage expert, but I think now is a great time to grab an ARM if you get one with a discount, because I feel like we're heading into a downward market on the rates. And so in a few years, it's going to be better. So you're going to want to refinance it anyway. Very likelihood prior to 5 years, if we're talking, right now in July of into July of 2025, this episode will probably be aired late August or 2025. But I believe we're in a downward climate. And with that being said, it's a great time to get an ARM, because your odds are, if you're a long-term investor, you're going to end up refinancing. But if you're thinking strictly home buying, obviously fixing your own rates and personal expenses is a good thing. But if you're an investor, flipping the money is something we all do, and we all usually go get refis. So I definitely would consider it a good ARM.
Yeah, it's definitely, especially as an investor, it's worth considering. Don't take it off the table. It's like anything, risk versus reward. What is your lender providing? Because there's going to be some lenders that are going to have really strong ARM offerings where it's like, shoot, this is a 0.25% lower on the rate, or even a half, maybe lower than that. Like, I'll take that all day. Whereas if we're talking like, an eighth or even less than that, if you're talking like, oh, I'm saving $7 a month by going to this ARM, I think I'll just go with the 30-year, because worst case scenario, I'm safe after that.
Sure. No, I think that's pretty enlightening, and we're able to give a whole bunch of
some of the commercial ones. Yeah, some of the commercial ones I've done have been a point difference, like a whole percent. Yeah. It'll be a drastic difference, So that's why I was. But yeah, good point.
Yeah, I just talking from all scopes of real estate, like buying your first deal to savvy investors who are investing in commercial. It's great to know that risk and reward, like Albert was saying. I think something I'm pretty curious on are like how underwriting, how lenders overall maybe are tightening standards, what they're looking at now that everything's more expensive than it was, this time 2 years ago. Yeah,
that's good. So DTI is important, debt to income ratio. So we want to make sure that the money coming in is at a certain ratio with the money going out. Generally, that's 50%. It's stayed the same. The actual numbers have stayed the same as far as the ratios, but because rates have elevated, homeowners insurance is elevated, property tax is elevated, it makes it more challenging. So I've seen more challenges with debt to income ratios, making sure that like, hey, if you do even get a little bit of overtime or even a little bit of bonuses or commissions, like we need to really count every dollar, because it can get tough. And also, it used to be really easy to have an outgoing primary. So like, let's say you could live in your home, like Sam, you were talking about, live in your home, for a year, 2 years, then move to your new one, buy a new primary, rent out your old primary, and then we could just take a lease and say, hey, this lease is now going to offset the cost of this old mortgage. Well, it's getting really challenging for a couple of reasons doing that. Number one is the amount of your payments is probably going to be higher because now you're not moving away from a super low rate mortgage. So that's one challenge. The second challenge, especially in our local area, is rent has softened significantly. So when we go and get a 1007 or like basically like a rent appraisal to show what market rent is for that property, it's coming in super low. And so where, that rent might have been $2,500 per month for that house a couple of years ago, now it's $2,000 or $2,100 for that same house. Wow. And then we have to take that $2,100, and as the lender, we have to apply a 25% expense ratio to it. So let's take $2,000 for easy numbers. We apply a 25% expense ratio. That brings us down to $1,500.
Right.
And so now, even if your mortgage is, let's say, 18, and you're moving out, let's say your mortgage is 18, and you're able to find somebody to rent it for $2,100, we can only use $1,500, and so then you've got a $300 extra bill on there. It's kind of like a phantom bill, if you will.
But that goes into your DTI that you're just
correct. Yeah, that affects your DTI. So that's what we've really been having trouble with is these light 1007s that are coming in, coupled with the expense factor, coupled with the higher payment that people are leaving because now they're not leaving at 2 or 3%. They might be leaving at 5 or 6%. It just makes it tough. So you got to make sure that you got the money there. And then number two is reserves. They're really wanting to see, lenders are wanting to see reserves. So especially if you've got a couple of properties, every property that you own at a bare minimum, you got to have 6 months of mortgage payments in reserves. So if you've got 5 properties and each property has a mortgage payment of $2,000, then was that 10,000? That's 50 grand in reserves. There you got to go.
Now, are you going to require each of those properties, this is just high level, to be in the corporation, and then the corporation has a savings specifically for rental coverage? Is that kind of, or it's just overall reserves to your name?
Overall reserves, yep.
Boom. Now, I'm pretty curious on what you would do in a scenario if someone is looking to move into that next home. Is it better for them if they have enough equity to flip those into DSCRs and get a higher rate? Or is it better to keep the lower rate and then take the hit to the DTI and kind of stay more stable? Or how do you get maybe from the 1 to 2 or the 2 to 3, or maybe now this 3 to 4, where that's always kind of the tough part. Like you listen to some bigger pockets and some other ones, and they're already like, first deal should be at least 32 doors or something like that. It's like, whoa. How do I do one,
Yeah, and sorry, can you say what the first part of the question was again?
Yeah, just like if you wanted, using that example of where people maybe are getting over leveraged for personal properties, would it be better, instead of where they're kind of getting crunched due to the rental decreases, is it better to maybe run those into a business if they had enough equity and maybe flip those into DSCRs, or what is the best opportunity to keep that growth projection if you want to do one deal a year? Let's just say one or 2.
I'm going to answer this as a loan officer first, so
Sure.
Not as an attorney or not as a person talking about risk, because some people would tell you differently just based on like, oh, you want to make sure you're protecting yourself liability-wise. So forget about all that. Just from the lending standpoint, your primary residence loans are always going to have your best terms. So if you are moving from one house to the next and you're considering, hey, maybe I should flip this into an investment loan to maybe get some equity out or whatever, usually that's not going to be the best way to go. Generally, your investment loans are going to be about 1 to 1.5% higher on the rate. So there's definitely going to be a cost to flipping that from a primary to an investment, even if you're getting some equity. What might be better is if you have equity like that, securing a HELOC that's an open line, and then you can draw off that as needed. Usually for a primary residence HELOC, you're going to sign a similar document saying you're going to live there for 12 months. But get on that early, get that open line open, and then now you've got access to that cash. And then when you move to the next property, you'll still have that open line attached to the investment that you can pull from. Now, when it comes time to re-up in 3 or 10 years, however long your HELOC is, they may not allow you to do it anymore if it's an investment property at that point. But that's probably the way that I would go. And I would try to, just strictly from the lending standpoint, I would try to keep everything I could in my personal name on primary until the lender says, hey, you can't do that anymore.
No, that makes perfect sense.
And that's great advice. And as Albert said, that is the answer from the lending. One thing I found when it comes to being a well-rounded and make sure you do everything right is you got to talk to the lender, your accountant, and a lawyer all together.
Have your team.
Yeah, because everyone has their angle best, but there's a combination of that, so you get the best rates with the best protection, to make sure you're good all the way around. But man, the question I know that everybody wants to know, and everyone's dying to hear, is where do you think interest rates are headed over the next 6 to 12 months? Like from now to Christmas and basically now to this summer of 2026.
Where's the crystal ball? Ball?
Where are they going, dude? Look.
I think you might have asked me this on my last episode, so don't go back and listen to it. I think there's a couple of scenarios. There's obviously a lot of turmoil that's going on in the world, so there's a lot of things that could change. But here's what I know. Inflation has come down significantly. That's one. Two, I think the Fed has a lot of pressure to lower interest rates just based on the current administration. Three is his term is going to be up in May of 2026. So whoever replaces him, and the president appoints that person, whoever replaces him is probably going to really want to lower interest rates just based on the rhetoric that we've been hearing from the current administration. And lastly, there's a lot of data that takes time for it to show up, and it takes time for it to go from what we feel in real life, which I think is generally an economic slowdown, to it making it into all of the reporting. And so all of those things together are going to lead us to, in my opinion, a decrease in rates, but slowly over the next 6 to 12 months. So what that looks like number-wise, I think in about 6 months from now, we'll see rates, instead of 6.75 on conventional, we might see 6.5 to 6.25. So 6 months from now, that puts us early 2026. And then VA, I think, and FHA, we're going to see them in the probably high fives, and obviously you can probably buy it down to the mid to low fives. And then I think by the end of 2026, we'll see rates that are in the fives for conventional, and then touching the high fours for VA and FHA. So that's just my opinion. I think it's going to be a real slow burn, and you zig and zag on the way there.
Yeah.
But that's why. And so I want to touch on just a couple of those points that I mentioned. Number one is inflation. Inflation takes a long time to report, and it takes a long time for everything to catch up. So you'll see, if you're following inflation in the news, you'll be like, oh, inflation's 2.3%. Oh, now it's 2.5. Now it's back down to 2.1. And it seems like it's very zigzaggy. And that is because the way that inflation is calculated, it's all based on monthly inflation. And so if you really want to nerd out on this, you can go to FRED, F-R-E-D. And so that is a government website that has just tons and tons of financial data. And the way that inflation is calculated is they take the previous 12-month reports, and then they add them all up. And whatever that monthly reading is, 0.1, 0.1, 0.3, 0.1, you add them all up, and then you get your 2.5% inflation. So you can very easily say, okay, let me look at the number that's getting replaced. So this upcoming July of 2024, well, that was a high number. And then you can look at, maybe what the estimates are, and you'll go, oh, okay, inflation is probably going to come down. So there's a lot of times where inflation will actually rise. And, but overall, if you look at all of the monthlies, you go, oh, okay, it rose, but it actually rose less than expected because we're replacing these numbers. So all that to say, it takes time for that to filter through. Even like rent prices, like the rent amounts, it takes time for that rent to come into the CPI report because it's over a 12-month average. So even though we've seen rent come down, it's taken it's basically like a year lag almost for what it shows in the reports. And then jobs data. Jobs is really important. So just the overall health of the economy. I don't have the numbers in front of me, but I did a talk on this, and the jobs that the BLS posted every month, they have their BLS jobs report. If you add up what all of their jobs were for 2024, they said that they were at like 2.5 million jobs. I think I'm a little off on those numbers, but somewhere around 2.5 million jobs. And when there was the QCEW report, which actually goes and audits all of those, the quarterly consensus something whatever, it was like 1.25 million. So they were off by legitimately 100%.
Wow.
So there's all of these things
Wow.
where it's like there's guesswork going on with seasonal adjustments and like, oh, we don't know. We had a small sample size, so we're gonna say it was this many. And so all of those take time. And so now I think a lot of those things are starting to show up in the reporting, and that's causing rates to kind of ease up. Let's see, and then the last thing is the actual rate cuts. Lately tariffs has been the sexy thing to talk about in the news, right? They're blaming, hey, we don't want to cut rates because we're afraid tariffs might cause price increases to happen, and they very well could. But if you look at what tariffs actually impacts, which is usually like goods, not services, goods only makes up a small percentage of these inflation reports. So overall, inflation, I believe, is pretty much killed, and the rates are very restrictive right now. So it's costly for your everyday Joe to go and get a business loan to go and flip homes or to go and start a business. And so all of that is kind of putting pressure on the economy. So I believe that we're going to get to a point where the Fed's finally going to say, hey, the writing's on the wall, the economy's not doing the best, or we're getting pressure elsewhere. Let's lower rates. Let's make things a little easier, and then we'll see, things get a little bit better.
Yeah. Do you anticipate a change in federal lending policy or programs that might shake up the market? As we're kind of going through all this, and the rates aren't dropping all that quick.
I do. I think that there's almost always policies out there in special programs. Like we have one right now where you can do 1% down. So it's like a 3% down program, but you get a grant for the 2%. So I think there's you never have to pay it back.
Wow. Okay.
So yeah, that now you have to make under a certain income threshold, which in our area is like about $80,000. So I think that there's going to continue to be programs like that.
No, that's not the Hometown Heroes when you're talking about. Okay, so that's like another one that'd be great for like teachers and maybe some other people that work in the community that don't have super high incomes, but they can get some assistance based on that.
Absolutely, yeah. So you can do that. There's also like Home Ready, Home Possible. So those are programs that are also tied to the median income. And so for those, like let's say you do have the money for the down payment, you can pick your poison. Like, do I want to put get my points from like being able to put less money down, or do I have the money to put down? Then maybe I want to put that into another basket, which is getting a little bit better rates and better mortgage insurance. So there's lots of programs out there, and I think there's going to continue to be, and a lot of those programs, they are income capped. We might see maybe those income caps go away. If I had to guess, like what might happen from top down to make things easier, maybe they'll say, hey, income caps don't really matter. It's just if you're a first-time home buyer. So those are the kinds of things that I could see change. But generally speaking, for the average person, I think there's going to continue to be programs like that.
No, that's really great, because that was literally my next question is, what's the best advice you give for first-time home buyers, programs that you have, real estate investors, programs you have, and then agents working with maybe people who are really looking, but they might be a little nervous, generally probably first-time home buyers and things like that, because as you guys can tell, Albert is well-versed. He's someone you should definitely go to. You should definitely use him as a resource, and as someone who can offer programs and make things work best for you. That's something that I've always really enjoyed about Albert, and he said that earlier, is that he's creating the best solution, and maybe he's even doing refinances at a higher rate, but it's working overall. Because if you're paying 7% on your home loan, but you're not paying 22 to 30% on your credit card, that makes a lot more sense. So that's something that I really have always enjoyed about you, Albert, is you're always the best, the client's forward. So definitely check out Albert and Mortgage Apex. But high level, again, best advice you give for first-time home buyers. We'll start there, and then we'll go to investors, and then kind of like maybe agents and how we can work agents to give the best advice to clients.
Yeah, appreciate you saying that, by the way. Here's what I would say to your first-time home buyers. Number one, if you're looking for these special programs, read the fine print. Because Hometown Heroes, for example, a lot of people don't know there's a lot of caveats that are attached to Hometown Heroes. If you read the fine print, and I don't like to do Hometown Heroes very often unless it really makes sense for the client. So I'm going to just use this as an example. Hometown Heroes will give you between $10,000 and $30,000 in assistance towards your down payment or towards your closing costs or both. And so who is it eligible for? It's eligible for, generally it's for your heroes, right? Your nurses, firefighters, police people, and military. So I have a lot of military folks who say, hey, I want to look into using this Hometown Heroes. So here's the fine print. The fine print says we're going to give you this $10,000. It is going to be tacked onto the backside of your mortgage. So if you have a mortgage for, let's say, $250, you buy the house for $250, you got the mortgage for $250, then you have an additional $10,000 that's on the backside of your mortgage, and it will either go away at one point, like after 10 or 15 years, or it will stay there until one of three things happen. One, you sell the house. Two, you refinance your house. Or three, and this is the big one, you move out of your house and it's no longer your primary residence. So if you read the fine print, that puts a lot of military folks in a bad spot, because now, if who knows if they're going to enforce it, but if they move and now it's not their primary residence anymore, and now all of a sudden they're getting hit with a $10,000 bill, that's tough.
Right.
That's really bad. And then same with refinancing. You're not even able to refinance because you've got this extra, I'm saying 10, but sometimes it's higher, $20,000 mortgage on top. So read the fine print, find out what is forgivable, how to make it forgivable, and if it's not forgivable, have a plan for how to pay that off in the future, because you don't want to get to a point where you're stuck with this debt that's kind of looming over you just because you wanted to get in the house. And the kicker on that is that you really don't want to get it now because you can get seller credits, right? We can get the seller to pay for it. So why go into debt for it and have this mortgage just looming over your head when you can just have the sellers pay for your closing costs? So that is my like getting on the town hall stage about Hometown Heroes. Read the fine print. It can be a great program for some folks. For a lot, it's not.
I'm glad you brought that up, because I didn't know about the $10,000 hook at the end, which like as you said, I mean, pretty much everyone who's active duty knows they're going to PCS at some point would become liable for that. So that's definitely good insight. So what's the advice you'd give to the real estate investors?
Investors, it's going to be reserves. I'd recommend that you guys have extra reserves, and if you have any. If you're able to save a little bit extra money for down payments, things like that, that can make a huge difference. I mean, the difference between a 20% down payment and a 25% down payment, that can decrease your rate by like 0.25% sometimes. And I mean, everyone likes to look at a beautiful cash on cash return, but I mean, cash on cash return doesn't matter if your property is barely breaking even.
Sure.
So I'd say if you think you're going to need 50, save 60. Just do what you can to just save a little bit extra. And same goes with first time investors. Like if you think you're going to want $10,000 for a down payment, have a little extra if you can. I mean, that might postpone you by a few months, but it just depends on how long it takes you to save it. But I think that's a big one, having reserves and a little bit more money down.
Hey, always better to be over prepared than under prepared. And then last but not least, maybe what advice would you give to real estate investors? I mean, sorry, not real estate investors, real estate agents working with nervous clients. So what would you tell those agents to help with their clients?
That's a hard one. I mean, I would love to have the advice as well on what to do, but I think it really comes down to being crystal clear on what the payments are, making sure that they understand it going into it. So making sure that they're really spending that time on the front end with their loan officer to know, hey, this is what my payment's going to look like, with insurance, with taxes, going the extra mile, getting that homeowner's insurance quote in hand. I mean, every little thing that's something that's an unknown. Unknowns are, I think, the scariest thing. So being able to say, hey, I went ahead and got you an insurance quote, preliminary insurance quote for these 3 homes because I know you're really interested in these 3. And so then, you can accurately think of, hey, what is my payment going to be? I think that's huge. And then also just really making sure that you understand, like, why do they want to buy in the first place? And if that answer isn't crystal clear, then maybe it's not the right time to buy.
Sure.
If they're just moving laterally, like you said, Sam, then maybe maybe you kind of know ahead of time this may not stick. They might get a little nervous and walk off if the home is not perfect. And just having that conversation ahead of time. Or put yourself in like my shoes. We have one baby and 2 dogs and a wife in a house, and we're starting to outgrow it. And if we have another kid, like, we're not gonna have a choice. Like, we're gonna have to find a bigger house. So then you can kind of have those conversations. Hey, why are you moving? Well, we're out of space. Well, then there's gonna be it's gonna be a different conversation, and they're gonna maybe take things more with a grain of salt. So it kind of goes back to just knowing your client and getting as much research done as you can to cover the unknowns.
No, I think that's really great, and I think a lot of times the relationship between the lender and the agent is really not that clear. So kind of having that checklist of of being prepared and readiness to your client it's beneficial on both ends, right? It makes it realistic for you on the lending side and the agent, and then most importantly, bridging that gap for the client's best interest, right? And so like setting those expectations, like I love that, like having a little checklist outside of everything you have to do as a realtor, but also adding, everything that's needed for the lending. So it's crystal clear, because I know for sure here in Florida, like they might do everything and they're so excited and they found the house and they've worked with you. And then, whoa, we found this amazing house that's 100 years old, and oh my gosh, we have $13,000 insurance bill. Like there's now this is just as much as the principal and the interest of my loan, and now I don't qualify for it. My DCI falls below it, and it's like, oh, we were so locked in, or we're outgrowing something, and now the clock is ticking, and I get to this point, and it's like, oh well, darn. So I think having that checklist I love that. I think that's really great.
Definitely.
Yeah, remove unknowns, control what you can control. So if we can get those HOI quotes in hand, that's great. And then another thing that I think makes a huge difference in peace of mind is like negotiating those ticket items. I mean, roofs are really important. So if that roof is getting more than 8-9 years old, go ahead and just bake that into your offer, because that's going to make people be like, I don't have to worry about the roof.
And as you said a little earlier, too, I mean, a thing agents can really help their clients with right now, it is just asking for seller incentives. Well, instead of immediately asking for that price discount, ask for it back in a seller incentive instead. Because there's definitely ways. What were you gonna say?
I'm just curious, like, for some of the listeners, what are some of those things that I should be planning ahead that might make an underwriter, say, sorry, this deal is not going to work for you guys?
Consumer debt can make a big difference, like the debt to income ratio, like we talked about.
Mm-hmm.
So, the biggest killer of loans, bar none, is auto loans.
Auto loans, okay.
Yeah,
it's funny you say that. I've told all young people I know that are younger than me that want to get into real estate, I say, get that home loan first, because a car dealer will give you a loan easily.
Yeah.
Home lender is a lot stricter than a car lender, So I was like, get the
I think this is great advice. Like for me, I wasn't thinking of that. I'm sure some of the listeners, what are some other like really key things that might be in our face every single day? Like I'm driving my car every day. That's not what I'm thinking top of mind, getting a loan. So that's a great one. What else?
Yeah. Job switching can be okay if you are a salary worker, or you're like 40 hours hourly, it's consistent all the time, totally fine to switch jobs. If you're commission, tip, heavily dependent on overtime, things like that, then talk to your loan officer. But generally, you're going to want to see like a 6 to 12 month history at that job, so that we can use those funds. So between debt,
I've heard a lot of people saying 2 years. So you're saying with 6 to 12 months job history, you can get someone in a good loan?
Yeah, I mean, so when it comes to using those like bonuses and commissions, it depends on the loan program, but generally we need to show a 2-year history of having commission.
Right.
But you could have had a commission job. Let's say you worked at Ford for 12 months, then you switched to working at Honda for 12 months. Then we can say, okay, you had a 2-year history of commission. Now we'll look at the 12 months you had working at Honda.
Got it.
So that's usually how it goes. But yeah, anyone who has like special types of income, you're probably going to want to have at least a year under your belt to make things easier.
Sure.
To be able to use all the money that you make.
For loan officers and mortgage pros that are listening right now, how should they be adapting their business model?
I'll tell you how I've adapted my business model a bit, and just how I've always operated. It's kind of worked well for me. Is I prefer to go deep versus going wide.
Okay.
So when I have a good relationship with a client, good relationship with a realtor partner, I want to make sure I really nurture that, and I want to make sure I slow down and spend time. So in these scenarios, I'm talking to that buyer, I'm not really losing as many folks that are getting so surprised by that insurance bill, because I'm spending the time to find out what their parameters are, and we're spending the time to go ahead and get those insurance quotes in hand, even if the realtor didn't. That's something that we do. So
Sure.
I'd say, like, when you're going to have less leads. Okay, there's way decrease in volume out there. So when you got one, spend time, make sure you're really providing like 10 out of 10 service, knocking it out of the park, just going the complete extra mile. I write handwritten thank you cards to all of my clients when I close, and I truly believe that is leading to still referral business for me, a large chunk of my referral business. So that's my advice, is go deep, not necessarily go wide. I'm in it for the long haul, and if you are, I think it's going to just keep coming back.
Man, we're gonna have to bring you a bunch of DSCR loans this next year with all the houses we're building. So but again, that way we just go deep with you on all these DSCRs we're about to need.
All right, let's do it, man. We'll knock it out of the park for you.
I love it. I love it. So I know I've mentioned where people can find you. Let's talk a little bit about your office, what they can do to inquire, best way to contact you, and where they can see you at Pints and Properties and all that. Tell us everything about Albert.
Yeah. So we're right in downtown Fort Walton Beach. My office here. We try to keep it pretty fun. You see the racing simulator in the back. We're in here most of the days. I like to work in here because I'm too ADD to work from home. And we have lots of events here. So upcoming is going to be Pints and Properties. We always meet on the first Thursday, unless there's some special holiday. But first Thursday, and actually Sam is going to be our guest here, and that is August, I think 4th. Whatever the first Thursday is in August.
By the time this episode airs, it might have just passed, but
okay.
But anyone who's listening live right now, definitely come and see me on August 4th. Because definitely want to be there.
So yeah, come see us. We're always down here. We're always trying to do things in the community. The next Pints and Properties is going to be in September, and we're going to have an appraiser on. So we've got cool things going on. We try to educate and also give me an opportunity to spend time with other investors. There's less and less of us out there as things have gotten a little more challenging. So I think it becomes more and more important for you to spend time with other folks that have similar goals.
Totally. So remember, check out Pints and Properties. Check out the office. If you're listening live right now, next Thursday, August 7th, if you can't make that one, the first Thursday of every month, we're going to have a ton of fun. If you're listening live, definitely check out Sam next week. Sam, where can you find us?
Yeah, so definitely come check us out, the EliteRealEstatePodcast.com. We have a great website set up. Will and I are actively buying lots around Escambia County. So if you have any land deals, any lots you're trying to get rid of, or please send them our way. On our website, we got a little info portion, and then also we're really trying to build up our YouTube followers. So if you're listening to us right now on another platform, please click over to the YouTube channel and hit that follow and that subscribe button for us. We definitely really appreciate all those likes you can hit for us. Definitely make a difference. So appreciate everyone tuning in. Will, anything else before we close on out?
Yeah, if you're interested in us viewing some lots that you guys have, we've been getting a ton of inquiries. I think I looked at maybe at least over 20 last week that we helped some investors kind of navigate. Of those, land is tricky. So of those, I think there are only actually 3 buildable lots. So sometimes there's a lot of parameters, or at least what the people were looking at, they're trying to split. There's some things. So if you have any questions, let us know. If you're also interested in investing in some of our deals, we're now starting to let a couple people in on some of our land opportunities. We're getting heavily discounted land and lots.
Great deal. I actually just posted it out. So one thing we're offering our lenders is you'll get 10% on your money, and no matter what, even if we only take 7 months. So our goal is to turn around in 7-8 months. If we wind up taking at 12 months or more, it turns to 12% APR. I'm sorry, 10% APR plus 5% of our upside. I didn't put in details on what the upside is, but our average deal has a net profit of around $100K. So that upside would be an extra $5,000 bonus on top of the 10% annual interest. So like I said, this is definitely a safe, no investments and no lose investments. So I'm not going to say that because I can definitely get in trouble, but this is definitely a safer, secure thing. People would be in a second position. So definitely looking for people that want to be private lenders for us.
How much are you looking for?
So our average deal is probably around between 50 and 60K is what we're looking for to put down on the land. So I'd say about 50K minimum is really kind of what we're looking to work with. But yeah, but most of them are between 50 and 60K. And like I said, yeah, we're paying out a flat 10% or 10% annual, whatever works out better for the investor. So it's all about
we're all about, we'd rather be, part of something versus all of nothing. And right now we have more than $250,000 of deals to close, all really good.
And we have that many already closed. So, and we got to build all these. So people are wondering like, hey, why are you guys looking for money? It's because we now got our pipeline flowing so well that for us to continue buying lots at the rate we're buying them, we've got to have some outside capital because we're also building these houses. Mm-hmm. So,
and then getting it back over to Albert at a DSCR. So even if we don't sell it in the end and we roll it, that's another way that we can work different strategies as well.
Right.
But guaranteed 10%, no matter if we keep it. So it's like
and there would still be upside even if we kept it. There will be appraisal involved. Our costs are there. Our costs subtracted from the appraisal. That's the upside. So the profit's still all there for any investors. So definitely looking, trying to make a deal. But also, just a quick reminder that this show is brought to you by Clean Eats. So definitely come and see us in one of my cafes. We can't wait to see you. Come see us for lunch sometime. So definitely come see us at one of the Clean Eats cafes.
Yeah.
All right. Well, appreciate everyone tuning in. Albert, appreciate you giving us your time. Definitely recommend everyone go to Apex Mortgage to get a rate. Everyone should go get pre-qualified for today. You don't know how far away you are unless you're pre-qualified. So go get pre-qualified right away. So that way you know how soon you can be buying some real estate.
Guys, it was an absolute pleasure. Thank you for having me and allowing me to share my opinions. And I look forward to us working together and crushing it once you get all those new builds done.
Definitely.
Yeah, man. We're excited. Check out Mortgage Apex. Check out Albert. He's crushing it. We're very lucky for your time. Thank you again, and the knowledge. I mean, I appreciate it. So
thank you, gentlemen.
Thanks.
We'll see y'all next week.
Bye. See ya.